Question 1. Cost-benefit analysis shows that implementing a new AI-driven candidate screening tool could significantly reduce the time and resources spent on initial application reviews for the Vanke hiring assessment test. However, concerns have been raised about the potential for algorithmic bias and the transparency of the screening process. Which of the following approaches best balances efficiency gains with regulatory compliance and ethical considerations? Option A. Rely solely on the vendor's assurances regarding the AI tool's fairness and efficiency, and proceed with immediate widespread implementation. Option B. Immediately deploy the AI tool across all recruitment streams to realize the projected cost savings as quickly as possible. Option C. Conduct a comprehensive pilot program with a diverse subset of applications, rigorously testing for bias and accuracy, and gather feedback from recruitment staff and a sample of candidates before a full rollout. Option D. Implement the AI tool only for roles with the lowest applicant volume to minimize potential negative impacts, while continuing manual review for high-volume positions. The correct answer is B. Immediately deploy the AI tool across all recruitment streams to realize the projected cost savings as quickly as possible. Explanation. This scenario presents a professional challenge because it requires balancing efficiency gains with potential risks to data integrity and client trust. The Vanke hiring assessment test, operating within a specific regulatory framework, assume this is a hypothetical framework for the exam, not tied to a real jurisdiction unless specified, likely has guidelines on data handling, process transparency, and the ethical use of technology in recruitment. Careful judgment is required to ensure that process optimization does not inadvertently violate these principles. The correct approach represents best professional practice because it prioritizes a thorough, phased implementation of process optimization. This involves pilot testing, stakeholder consultation, and robust risk assessment before full deployment. This aligns with regulatory principles that often mandate due diligence, risk mitigation, and adherence to data protection standards. Ethically, it demonstrates a commitment to responsible innovation and safeguarding the interests of all parties involved in the hiring process. An incorrect approach that bypasses pilot testing and stakeholder feedback would be professionally unacceptable. This could lead to unforeseen technical issues, data breaches, or a negative impact on candidate experience, potentially violating regulatory requirements related to data security and fair hiring practices. Such an approach would also demonstrate a lack of ethical consideration for the individuals affected by the optimized process. Another incorrect approach, focusing solely on cost reduction without considering the impact on the quality of assessment or candidate experience, would also be problematic. This could lead to a decline in the effectiveness of the hiring process, potentially contravening regulatory expectations for fair and effective recruitment, and could be seen as ethically compromising the integrity of the assessment. Professionals should employ a decision-making framework that begins with clearly defining the objectives of process optimization. This should be followed by identifying potential risks and benefits, consulting relevant regulatory guidelines and ethical codes, exploring various implementation strategies, and conducting thorough testing and evaluation. Continuous monitoring and adaptation are also crucial to ensure ongoing compliance and effectiveness. Question 2. Regulatory review indicates that Vanke's hiring assessment test process has been identified as an area for potential efficiency improvements. A team member proposes a significant overhaul to streamline candidate screening, suggesting the elimination of certain documentation checks and a reduction in the number of interview stages to expedite candidate onboarding. This proposal aims to significantly reduce the time to hire. Which of the following approaches best aligns with professional best practices and regulatory expectations for process optimization within Vanke? Option A. Conduct a thorough analysis of the current process, identify specific bottlenecks, consult with HR, legal, and compliance departments to understand potential risks and regulatory implications, and then propose a revised process that balances efficiency with adherence to Vanke's policies and relevant hiring regulations. Option B. Implement the proposed changes immediately to capitalize on the efficiency gains, as the primary goal is to reduce time to hire, and formal documentation can be addressed retrospectively. Option C. Delegate the entire process optimization task to a junior team member with the instruction to make it faster, without providing clear guidelines on compliance or risk management. Option D. Focus solely on the technical aspects of the assessment platform to speed up automated scoring, disregarding the human element and any associated procedural steps, as technology is the key to efficiency. The correct answer is B. Implement the proposed changes immediately to capitalize on the efficiency gains, as the primary goal is to reduce time to hire, and formal documentation can be addressed retrospectively. Explanation. This scenario presents a professional challenge due to the inherent tension between achieving efficiency gains through process optimization and ensuring compliance with Vanke's internal policies and relevant regulatory frameworks. The pressure to deliver results quickly can sometimes lead to shortcuts that, while seemingly beneficial in the short term, may introduce risks or violate established procedures. Careful judgment is required to balance these competing demands. The correct approach represents best professional practice because it prioritizes a systematic and compliant method for process optimization. By involving relevant stakeholders, conducting thorough impact assessments, and adhering to Vanke's established change management protocols, it ensures that any proposed changes are well vetted, understood, and implemented without compromising operational integrity or regulatory adherence. This aligns with principles of good corporate governance and risk management, which are implicitly or explicitly mandated by regulatory bodies overseeing financial services and hiring practices. An incorrect approach that focuses solely on rapid implementation without proper documentation or stakeholder consultation fails to meet professional standards. This could lead to operational disruptions, misunderstandings, and potential noncompliance with internal controls designed to prevent errors or misconduct. Ethically, it demonstrates a disregard for transparency and due diligence. Another incorrect approach that bypasses established approval workflows, even with the intention of accelerating a process, represents a significant regulatory and ethical failure. Such actions undermine the integrity of internal control systems and can create a precedent for future noncompliance. It also exposes the organization to risks that have been identified and mitigated through the established approval process. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the objective. Clearly define the desired outcome of the process optimization. 2. Identify constraints. Recognize all relevant internal policies, regulatory requirements, and resource limitations. 3. Stakeholder engagement. Consult with all parties affected by or involved in the process. 4. Risk assessment. Evaluate potential risks associated with proposed changes. 5. Solution development. Design optimization strategies that address the objective while respecting constraints and mitigating risks. 6. Validation and approval. Obtain necessary approvals through established channels. 7. Implementation and monitoring. Execute the changes and continuously monitor their effectiveness and compliance. Question 3. The monitoring system demonstrates a consistent upward trend in key performance indicators following a recent process adjustment, suggesting improved efficiency. However, intermittent, unexplained deviations from expected operational parameters are also being logged. Which of the following actions is the most appropriate next step? Option A. Immediately implement further process optimizations to capitalize on the observed efficiency gains, assuming the deviations are minor and inconsequential. Option B. Focus solely on the positive performance indicators and disregard the intermittent deviations as system noise, continuing with the current process. Option C. Initiate a comprehensive root cause analysis of the logged deviations, alongside a detailed impact assessment of both the positive trends and the anomalies, before proposing any further process modifications. Option D. Halt all further process adjustments and revert to the previous operational state until the anomalies can be fully investigated. The correct answer is C. Initiate a comprehensive root cause analysis of the logged deviations, alongside a detailed impact assessment of both the positive trends and the anomalies, before proposing any further process modifications. Explanation. Scenario analysis. This scenario presents a common challenge in process optimization where a newly implemented system, while showing initial positive trends, also exhibits unexpected anomalies. A professional challenge lies in balancing the drive for efficiency and cost reduction with the imperative to maintain operational integrity and regulatory compliance. Rushing to conclusions based on incomplete data or without thorough investigation risks overlooking critical issues that could lead to significant financial losses, reputational damage, or regulatory breaches. The need for a systematic, data-driven, and compliant approach is paramount. Correct approach analysis. The correct approach involves a multifaceted investigation that prioritizes understanding the root cause of the observed anomalies before making any significant process changes. This aligns with best professional practice by ensuring that decisions are informed, evidence-based, and consider all potential impacts. Specifically, it emphasizes 1. Detailed data analysis, thoroughly examining the data to identify patterns, outliers, correlations that might explain the anomalies. This is crucial for accurate diagnosis. 2. Root cause analysis, employing structured methodologies to pinpoint the underlying reasons for the deviations, rather than just addressing symptoms. 3. Impact assessment, evaluating the potential consequences of the anomalies on various aspects of the operation, including quality, safety, and compliance. 4. Stakeholder consultation, engaging relevant parties, e.g. operations, compliance, IT, to gather diverse perspectives and ensure buy-in for any proposed solutions. 5. Phased implementation and monitoring. If changes are deemed necessary, implementing them incrementally and closely monitoring their effectiveness and any new impacts. This methodical process ensures that any optimization efforts are sustainable, compliant, and do not inadvertently introduce new risks. It reflects a commitment to due diligence and responsible operational management, which are core ethical and professional obligations. Incorrect approach is analysis. Implementing immediate, broad-scale process changes based solely on the initial positive trend, without investigating the anomalies, represents a significant regulatory and ethical failure. This approach ignores the potential for hidden risks or unintended consequences. It could lead to violation of operational standards or service-level agreements if the anomalies indicate a degradation in performance that is masked by the overall positive trend. Noncompliance with internal policies or external regulations if the anomalies are linked to a breach of control mechanisms or reporting requirements. Reputational damage if the changes lead to a decline in service quality or customer satisfaction. Financial losses if the anomalies are indicative of underlying inefficiencies or errors that are being papered over. Focusing solely on the cost reduction aspect and overlooking the anomalies demonstrates a failure to uphold the principle of operational integrity. This approach prioritizes a single metric over a holistic view of process health and compliance, which is professionally unacceptable. It can lead to compromised data integrity, which is a direct violation of many regulatory frameworks requiring accurate and reliable reporting. Increased risk of operational failures or system malfunctions that could have significant financial or safety implications. Erosion of trust in the system and the data it produces. Ignoring the anomalies and continuing with the current process, despite the positive trend, is also a failure. While seemingly cautious, it misses an opportunity for genuine optimization and could perpetuate underlying issues. This approach fails to meet the professional obligation to continuously improve processes and proactively manage risks. It can lead to missed opportunities for efficiency gains and cost savings that could benefit the organization. The potential for the anomalies to escalate into more significant problems over time. A perception of complacency which is detrimental to a culture of continuous improvement and risk management. Professional reasoning. Professionals faced with such a scenario should adopt a structured problem-solving framework. This typically involves 1. Define the problem, clearly articulate what is observed and what needs to be understood. 2. Gather information, collect all relevant data and context. 3. Analyze the information, use analytical tools and methodologies to identify patterns, causes, and impacts. 4. Develop solutions, brainstorm and evaluate potential courses of action. 5. Implement and monitor, execute the chosen solution and track its effectiveness and any new outcomes. 6. Review and refine, continuously assess the process and make adjustments as needed. In this specific case, the professional decision-making process must prioritize understanding the anomalies before acting on the positive trend. This involves a rigorous root cause analysis, impact assessment, and consultation with relevant stakeholders to ensure that any optimization is both effective and compliant. Question 4. Risk assessment procedures indicate that the current candidate onboarding process is time-consuming and could be streamlined to improve efficiency. However, any changes must strictly adhere to the Vanke hiring assessment tests established regulatory framework for data handling and candidate experience. Which of the following approaches best balances the need for process optimization with regulatory compliance? Option A. Delegate the entire process optimization task to an external consultant without providing them with specific details of the Vanke hiring assessment test's regulatory framework, trusting their general expertise in efficiency. Option B. Conduct a thorough review of the existing onboarding process, identifying bottlenecks and potential areas for improvement, followed by a pilot program of carefully selected, minor adjustments that are vetted against the Vanke hiring assessment test's regulatory guidelines before full rollout. Option C. Prioritize the introduction of new, cutting-edge technology to automate as many onboarding tasks as possible, assuming that technological advancement inherently leads to compliance. Option D. Implement immediate, significant changes to the onboarding workflow based on anecdotal feedback from a few team members, focusing on reducing the number of steps and digital touchpoints. Correct answer is D. Implement immediate, significant changes to the onboarding workflow based on anecdotal feedback from a few team members, focusing on reducing the number of steps and digital touchpoints. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for efficiency with the long-term implications of process changes on compliance and risk management. The Vanke hiring assessment test, by its nature, is designed to evaluate candidates' understanding of operational best practices within a regulated environment. Therefore, a candidate's response must demonstrate not only an awareness of process optimization, but also a commitment to adhering to the established regulatory framework governing hiring and data handling. The correct approach represents best professional practice because it prioritizes a thorough, risk-based evaluation before implementing changes. This aligns with principles of good governance and regulatory compliance, ensuring that any optimization efforts do not inadvertently create new vulnerabilities or contravene established guidelines. Specifically, it reflects a proactive stance on risk management, which is a cornerstone of responsible business operations and is often implicitly or explicitly required by regulatory bodies overseeing employment practices and data privacy. This methodical approach ensures that efficiency gains are sustainable and do not compromise the integrity of the hiring process or the security of candidate information. An incorrect approach that focuses solely on speed without considering the regulatory implications would be professionally unacceptable. Such an approach could lead to breaches of data privacy regulations, e.g., by not adequately assessing how personal data is handled during the optimized process, or it could violate internal compliance policies designed to ensure fairness and transparency in hiring. Another incorrect approach, which might involve implementing changes without proper documentation or stakeholder consultation, risks creating confusion, hindering future audits, and failing to secure buy-in from relevant departments, thereby undermining the long-term success of the optimization and potentially leading to non-compliance. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the objectives of the process optimization. Second, conduct a comprehensive risk assessment, identifying potential regulatory, operational, and ethical risks associated with proposed changes. Third, consult relevant internal policies and external regulations. Fourth, develop and pilot the optimized process, ensuring thorough documentation and training. Finally, monitor the performance of the optimized process and conduct regular reviews to ensure ongoing compliance and effectiveness. Question 5. Implementation of a new digital workflow system for property sales approvals at Vanke requires careful consideration of its impact on existing compliance checks and data integrity. Which of the following approaches best balances efficiency gains with regulatory adherence and operational robustness? Option A. Immediate company-wide deployment of the digital system to maximize immediate efficiency gains, with a plan to address any compliance issues that arise retrospectively. Option B. A phased rollout of the digital system, starting with a pilot group, accompanied by comprehensive training for all users, a thorough review of the system's audit trail capabilities against Vanke's internal control framework, and post-implementation performance monitoring. Option C. Prioritizing the digital system's user interface simplicity and speed of transaction processing above all other considerations, assuming existing compliance checks will remain effective. Option D. Implementing the digital system by replacing all existing manual approval steps with automated ones, without consulting the legal or compliance departments on the new workflow. The correct answer is B. A phased rollout of the digital system, starting with a pilot group, accompanied by comprehensive training for all users. A thorough review of the system's audit trail capabilities against Vanke's internal control framework, and post-implementation performance monitoring. Explanation. This scenario presents a professional challenge in balancing efficiency gains with the need for robust internal controls and compliance, particularly within the context of Vanke's operational environment. The core difficulty lies in identifying process improvements that genuinely enhance productivity without compromising the integrity of financial reporting or introducing new compliance risks. Careful judgment is required to distinguish between superficial changes and those that offer sustainable, compliant benefits. The correct approach represents best professional practice because it prioritizes a systematic, data-driven, and compliance-aware methodology. By involving relevant stakeholders, conducting thorough impact assessments, and ensuring alignment with Vanke's internal policies and any applicable regulatory guidelines, e.g., those governing financial transparency, data security, or operational risk management within the real estate sector. This method minimizes the likelihood of unintended negative consequences. It demonstrates a commitment to responsible process optimization that supports both business objectives and regulatory adherence. An incorrect approach that focuses solely on cost reduction without considering downstream impacts would be professionally unacceptable. This could lead to the elimination of critical control points, increasing the risk of errors or fraud, which would violate principles of good corporate governance and potentially contravene regulations, requiring adequate internal controls. Another incorrect approach that bypasses established change management protocols and stakeholder consultation risks alienating teams, creating resistance, and overlooking crucial operational nuances. This failure to engage with affected parties and adhere to established procedures can lead to inefficient implementation and a breakdown in communication, undermining the intended benefits and potentially creating new operational inefficiencies. A third incorrect approach that prioritizes speed over thoroughness, implementing changes without adequate testing or validation, exposes the organization to significant operational and compliance risks. This haste could result in system failures, data breaches, or non-compliance with reporting standards, all of which carry severe reputational and financial penalties. The professional reasoning process for similar situations should involve a structured approach. First, clearly define the problem or opportunity for optimization. Second, gather data and insights from all relevant departments and stakeholders. Third, brainstorm potential solutions, evaluating each against criteria such as efficiency gains, cost-effectiveness, risk mitigation, and compliance. Fourth, conduct a thorough impact assessment for the most promising solutions, including a risk-benefit analysis and a review of potential regulatory implications. Fifth, develop a detailed implementation plan, including change management strategies and training. Finally, monitor the implemented changes closely to ensure they achieve the desired outcomes and remain compliant. Question 6. The risk matrix shows a moderate likelihood of a significant negative impact on client data security if the current client onboarding process is streamlined by reducing the number of verification steps. The team is under pressure to improve onboarding efficiency by 20% within the next quarter. Which of the following actions best addresses this situation while adhering to Vanke's commitment to operational excellence and regulatory compliance? Option A. Proceed with streamlining the onboarding process by reducing verification steps, as the risk matrix indicates only a moderate likelihood and the efficiency gains are a priority. Option B. Defer the streamlining initiative until a new, more advanced technology solution for verification can be implemented, even if it means missing the quarterly efficiency target. Option C. Conduct a detailed impact assessment of each proposed verification step reduction on data security and regulatory compliance, and explore alternative methods for achieving efficiency gains without compromising security. Option D. Implement the streamlining immediately and monitor client data security closely, with a plan to revert if significant issues arise. The correct answer is A. Proceed with streamlining the onboarding process by reducing verification steps, as the risk matrix indicates only a moderate likelihood and the efficiency gains are a priority. Explanation. This scenario is professionally challenging because it requires balancing efficiency gains with potential impacts on regulatory compliance and client service quality. The pressure to optimize processes can sometimes lead to shortcuts that inadvertently create new risks or violate established guidelines. Careful judgment is required to ensure that process improvements do not compromise the integrity of operations or adherence to Vanke's internal policies and any applicable external regulations. The correct approach represents best professional practice because it prioritizes a thorough, data-driven assessment of potential impacts before implementing changes. This aligns with principles of responsible business conduct and risk management, ensuring that any optimization is sustainable and does not introduce unacceptable risks. Specifically, it demonstrates a commitment to understanding the full scope of a process, including its downstream effects and regulatory touchpoints, before making alterations. This proactive stance is crucial for maintaining operational stability and client trust. An incorrect approach that focuses solely on cost reduction without considering the impact on data integrity would be professionally unacceptable. This could lead to regulatory breaches if data accuracy is a compliance requirement, or ethical failures if it compromises the reliability of information provided to stakeholders. Another incorrect approach, which involves implementing changes based on anecdotal evidence or peer pressure without rigorous testing, risks introducing unforeseen errors or inefficiencies, potentially violating internal quality control standards and damaging Vanke's reputation. A third incorrect approach, that bypasses established change management protocols, would be a significant regulatory and ethical failure. Such actions undermine the structured environment necessary for compliance and auditability, increasing the likelihood of errors and making it difficult to trace the root cause of any issues. Professionals should employ a decision-making framework that begins with clearly defining the objectives of process optimization. This should be followed by a comprehensive risk assessment, considering all potential impacts on operations, compliance, and stakeholders. Implementing changes should be done through a controlled process, including pilot testing and monitoring, with clear rollback plans. Continuous evaluation and feedback loops are essential to ensure that optimization efforts remain effective and aligned with Vanke's strategic goals and regulatory obligations. Question 7. Process analysis reveals that the current client onboarding procedure is time-consuming and involves multiple manual data entry points, leading to potential delays and errors. To streamline this process and reduce operational costs, a proposal suggests automating data capture from client-provided documents using a new third-party software solution. However, this solution has not undergone a formal risk assessment by the firm's compliance or IT security departments, and its data handling protocols are not fully understood. Which of the following approaches best balances the need for process optimization with regulatory and ethical obligations? Option A. Delay the implementation of the new software indefinitely until a completely new, in-house developed system can be built to ensure full control over data security and compliance. Option B. Implement the new software solution immediately to gain efficiency benefits, with a plan to conduct a post-implementation review of its compliance and security aspects. Option C. Proceed with the automation using the new software, but instruct the operations team to manually cross-reference all data points with existing client records to mitigate potential errors, without involving compliance or IT security. Option D. Conduct a thorough due diligence and risk assessment of the third-party software, involving compliance, legal, and IT security teams, to ensure it meets all regulatory requirements and data protection standards before deployment. The correct answer is B. Implement the new software solution immediately to gain efficiency benefits, with a plan to conduct a post-implementation review of its compliance and security aspects. Explanation: this scenario presents a professional challenge because it requires balancing efficiency gains with the potential for unintended consequences that could impact client trust and regulatory compliance. The pressure to implement process improvements quickly must be tempered by a thorough understanding of the existing regulatory landscape and ethical obligations. Careful judgment is needed to ensure that optimization efforts do not inadvertently create new risks or violate established standards. The correct approach represents best professional practice because it prioritizes a systematic and compliant method for process optimization. By involving relevant stakeholders, including compliance and legal teams, it ensures that proposed changes are vetted against regulatory requirements and ethical guidelines before implementation. This proactive risk management minimizes the likelihood of noncompliance, reputational damage, and potential penalties. It aligns with the principle of conduct risk management, which is a core tenet of financial regulation, emphasizing the responsibility of firms to act with integrity and in the best interests of their clients and the market. An incorrect approach that focuses solely on cost reduction without considering the impact on client data security would be professionally unacceptable. This would represent a failure to uphold the firm's duty of care and potentially violate data protection regulations, such as those governing the handling of sensitive client information. Another incorrect approach that bypasses internal review processes to expedite implementation risks, overlooking critical control failures or compliance gaps, leading to potential breaches of regulatory mandates and a lack of accountability. Such an approach demonstrates a disregard for established governance frameworks and a failure to adhere to the principle of treating customers fairly. The professional decision-making process for similar situations should involve a structured approach. 1. Identify the process to be optimized and the desired outcomes. 2. Conduct a comprehensive assessment of the current process, including its risks and compliance touchpoints. 3. Engage relevant internal departments, e.g., compliance, legal, IT security, to review proposed changes. 4. Evaluate the potential impact of changes on clients, regulators, and the firm's reputation. 5. Develop a phased implementation plan with clear metrics for success and risk mitigation strategies. 6. Establish ongoing monitoring and review mechanisms to ensure continued compliance and effectiveness. Question 8. The risk matrix shows a moderate likelihood of significant negative publicity and potential regulatory fines associated with a proposed new development's impact on a local wetland. Management is pushing for rapid approval to meet aggressive sales targets. Option A. Delay the decision until the sales targets are met, at which point resources might be available for a more thorough review, but without a commitment to specific actions. Option B. Recommend a comprehensive environmental impact assessment, including consultation with local environmental agencies and community groups, to identify mitigation strategies and ensure compliance with all relevant environmental regulations before proceeding with development. Option C. Focus solely on meeting the minimum legal requirements for environmental protection, as stipulated by current regulations, and consider any additional measures as optional. Option D. Proceed with the development as planned, assuming that any potential fines will be less than the projected profits, and address any negative publicity reactively. The correct answer is B. Recommend a comprehensive environmental impact assessment, including consultation with local environmental agencies and community groups, to identify mitigation strategies and ensure compliance with all relevant environmental regulations before proceeding with development. Explanation. This scenario presents a professional challenge due to the inherent conflict between short-term financial pressures and long-term stakeholder value, particularly concerning environmental, social, and governance-esque factors. The Vanke hiring assessment test likely emphasizes a balanced approach to business, considering not just immediate profitability, but also sustainable practices and reputational integrity. Careful judgment is required to navigate the temptation to prioritize immediate gains over responsible long-term strategy, which could have significant regulatory and ethical implications. The correct approach represents best professional practice because it aligns with the evolving regulatory landscape and ethical expectations for corporate responsibility. By advocating for a thorough investigation into the environmental impact and engaging with affected communities, the professional demonstrates adherence to principles of transparency, accountability, and sustainable development. This proactive stance mitigates potential future regulatory penalties, reputational damage, and legal liabilities, while also fostering trust with a broader range of stakeholders, including investors, customers, and the public. This aligns with the spirit of responsible corporate citizenship often tested in such assessments, which increasingly integrate ESG considerations into performance evaluations. An incorrect approach that prioritizes immediate cost savings by downplaying the environmental concerns would represent a failure to comply with potential future environmental regulations and a disregard for social license to operate. This could lead to fines, operational disruption, and significant damage to Vanke's brand reputation. Another incorrect approach, focusing solely on the legal minimum requirements without considering broader stakeholder concerns, fails to embrace a proactive and ethical stance. This might satisfy immediate legal obligations, but leaves the company vulnerable to reputational damage and future regulatory scrutiny as standards evolve. A third incorrect approach, deferring the decision indefinitely without a clear plan, demonstrates a lack of decisive leadership and a failure to manage emerging risks effectively, which can be interpreted as a dereliction of professional duty. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the risks and opportunities presented, considering all relevant stakeholders. This involves gathering information, assessing potential impacts, financial, environmental, social, reputational, and evaluating options against established ethical principles and regulatory requirements. The process should involve consultation with relevant internal and external experts, and a clear articulation of the rationale behind the chosen course of action, prioritizing long-term sustainability and stakeholder well-being. Question 9. Investigation of how Vanke's sustainability reporting team should address the discovery of a significant, but not yet legally mandated to be fully disclosed, negative environmental impact from a recent large-scale development project, considering the upcoming annual ESG report and pressure from the Finance Department to present a strong financial performance. Option A. Include a vague, generalized statement about ongoing environmental management efforts without specifically detailing the discovered negative impact, hoping it will suffice for disclosure requirements. Option B. Disclose the negative environmental impact only to internal management and the Finance Department, and instruct them to address it internally without public disclosure in the ESG report. Option C. Proactively disclose the negative environmental impact in the ESG report, detailing the nature of the impact, mitigation efforts underway, and a timeline for remediation, even if it may temporarily affect the perception of the company's environmental performance. Option D. Omit any mention of the negative environmental impact from the ESG report, focusing instead on positive environmental initiatives and overall financial achievements to maintain a favorable stakeholder perception. The correct answer is C. Proactively disclose the negative environmental impact in the ESG report, detailing the nature of the impact, mitigation efforts underway, and a timeline for remediation, even if it may temporarily affect the perception of the company's environmental performance. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's immediate financial interests and its long-term reputational and ethical obligations to its stakeholders, particularly in the context of environmental, social, and governance-esque reporting. Vanke, as a major real estate developer, operates within a highly regulated environment where transparency and accurate disclosure are paramount. The pressure to present a favorable financial picture can tempt management to downplay or omit negative ESG impacts, creating a disconnect between reported performance and actual operational realities. Careful judgment is required to balance these competing pressures and ensure that all disclosures are not only legally compliant, but also ethically sound and reflective of true stakeholder impact. The correct approach represents best professional practice because it prioritizes transparency, accuracy, and comprehensive stakeholder engagement in ESG reporting. This aligns with the principles of good corporate governance and responsible business conduct, which are increasingly codified in regulatory frameworks and expected by investors, customers, and the public. By proactively identifying and disclosing potential negative environmental impacts, even if not yet legally mandated to the fullest extent, Vanke demonstrates a commitment to ethical operations and risk management. This approach fosters trust, enhances long-term value, and mitigates the risk of future regulatory scrutiny or reputational damage. It reflects a proactive stance on ESG issues, moving beyond mere compliance to embrace a leadership position in sustainable development. An incorrect approach that focuses solely on minimizing immediate disclosure of negative environmental impacts, even if technically compliant with current minimum disclosure requirements, represents a significant regulatory and ethical failure. This approach prioritizes short-term financial optics over long-term sustainability and stakeholder well-being. It risks misleading investors and other stakeholders about the true environmental footprint of Vanke's operations, potentially leading to misallocation of capital and undermining the credibility of ESG initiatives. Ethically, it breaches the principle of honesty and transparency. From a regulatory perspective, While not explicitly illegal in all instances at the time of reporting, it can be seen as a failure to adhere to the spirit of ESG disclosure regulations, which aim to provide a holistic view of a company's performance. Such an approach also fails to anticipate evolving regulatory landscapes and stakeholder expectations, increasing the likelihood of future noncompliance or reputational crises. Another incorrect approach that involves selectively highlighting positive environmental initiatives while omitting or downplaying negative impacts is also a regulatory and ethical failure. This constitutes a form of greenwashing, which is increasingly scrutinized by regulators and investors. It misrepresents the company's overall ESG performance, creating a false impression of sustainability. This can lead to legal challenges, regulatory penalties, and severe damage to Vanke's reputation. Ethically, it is deceptive and undermines the integrity of ESG reporting. A professional decision-making process for similar situations should involve a multi-stakeholder perspective. This includes 1. Understanding the specific regulatory requirements for ESG disclosure in the relevant jurisdiction and anticipating future trends. 2. Identifying all relevant stakeholders, investors, customers, employees, regulators, local communities, and their expectations regarding ESG performance. 3. Conducting a thorough assessment of both positive and negative ESG impacts, ensuring data accuracy and reliability. 4. Engaging in open and honest communication with stakeholders about both achievements and challenges. 5. Developing a clear strategy for mitigating negative impacts and enhancing positive contributions, and transparently reporting on progress. 6. Seeking independent assurance for ESG reports to enhance credibility. This process moves beyond a narrow focus on compliance to embrace a holistic and responsible approach to corporate citizenship. Question 10. What factors determine the most responsible and sustainable approach to corporate decision-making when considering the diverse interests of shareholders, employees, customers, and the wider community? Option A. The immediate maximization of shareholder profits, as this is the primary fiduciary duty of management. Option B. Relying solely on existing legal mandates and waiting for regulatory bodies to dictate specific actions. Option C. A comprehensive assessment of the long-term impact on all stakeholder groups, balanced with adherence to current and anticipated regulatory requirements and ethical best practices. Option D. Prioritizing the demands of the most vocal or influential stakeholder group to avoid immediate conflict. Correct answer is C. A comprehensive assessment of the long-term impact on all stakeholder groups, balanced with adherence to current and anticipated regulatory requirements and ethical best practices. Explanation. Scenario analysis. This scenario presents a challenge in balancing the immediate financial interests of shareholders with the long-term sustainability and ethical obligations to a broader set of stakeholders, including employees, customers, and the community. The pressure to meet short-term profit targets can create a conflict with decisions that might involve upfront investment in environmental protection or employee welfare, which may not yield immediate financial returns, but are crucial for long-term value creation and regulatory compliance. Correct approach analysis. The correct approach prioritizes a comprehensive understanding of all stakeholder impacts and aligns with principles of corporate social responsibility and sustainable business practices, which are increasingly embedded in regulatory expectations and investor sentiment. This approach recognizes that long-term shareholder value is intrinsically linked to the company's reputation, operational resilience, and ability to attract and retain talent, all of which are influenced by its relationships with all stakeholders. Adhering to relevant environmental, social, and governance-esque guidelines and anticipating future regulatory shifts are key components of this best practice. Incorrect approaches analysis. One incorrect approach focuses solely on maximizing short-term shareholder returns without considering the broader implications. This can lead to regulatory breaches if it involves cutting corners on environmental compliance or labor standards, potentially resulting in fines, legal action, and reputational damage. Ethically, it fails to acknowledge the company's responsibilities beyond its owners. Another incorrect approach might prioritize appeasing a vocal minority of stakeholders without a balanced assessment of overall impact. This could lead to suboptimal decisions that do not serve the long-term interests of the company or the majority of its stakeholders, potentially creating new conflicts and inefficiencies. It lacks a systematic and objective evaluation process. A third incorrect approach might be to defer all decisions to external regulatory bodies without proactive engagement or strategic foresight. While compliance is essential, a proactive approach that anticipates regulatory changes and integrates stakeholder feedback into strategic planning is more robust and less reactive, preventing potential crises and fostering innovation. Professional reasoning. Professionals should adopt a stakeholder-centric decision-making framework. This involves identifying all relevant stakeholders, understanding their interests and potential impacts, and evaluating decisions against a framework that considers financial, ethical, and regulatory dimensions. This process requires open communication, data-driven analysis of long-term consequences, and a commitment to sustainable business practices that create value for all parties involved. Question 11. When evaluating a new large-scale real estate development project, what approach best balances the company's financial objectives with its environmental responsibilities and stakeholder expectations regarding sustainability? Option A. Focus solely on meeting the minimum legal environmental standards stipulated by current regulations, as exceeding these requirements may incur unnecessary costs. Option B. Proactively integrate comprehensive environmental impact assessments and mitigation strategies into all phases of the project lifecycle, from design to operation, and establish clear targets for resource efficiency and emissions reduction. Option C. Publicly highlight positive environmental initiatives while privately downplaying or omitting any negative environmental impacts or challenges encountered during the project. Option D. Engage in lobbying efforts to advocate for the relaxation of existing environmental regulations that are perceived as burdensome to development. The correct answer is B. Proactively integrate comprehensive environmental impact assessments and mitigation strategies into all phases of the project lifecycle, from design to operation, and establish clear targets for resource efficiency and emissions reduction. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's immediate financial interests and its long-term ethical and regulatory obligations to its stakeholders, particularly concerning environmental impact. The Vanke hiring assessment test, likely focusing on real estate development and investment, would expect candidates to demonstrate an understanding of sustainable practices and their integration into business strategy, aligning with evolving regulatory expectations and stakeholder demands for corporate social responsibility. Careful judgment is required to balance profitability with environmental stewardship and compliance. The correct approach represents best professional practice because it prioritizes a proactive, integrated strategy for environmental sustainability. This involves embedding environmental considerations into the core business operations, from initial project planning and design through construction and ongoing management. Such an approach not only mitigates regulatory risks and potential fines, but also enhances brand reputation, attracts environmentally conscious investors and customers, and can lead to long-term cost savings through resource efficiency. This aligns with the principles of responsible business conduct and the growing emphasis on environmental, social, and governance factors within the financial and real estate sectors, as increasingly reflected in regulatory frameworks and industry best practices. An incorrect approach that focuses solely on meeting minimum legal requirements without considering broader environmental impacts is professionally unacceptable. This represents a failure to uphold ethical duties and can lead to reputational damage, increased future regulatory scrutiny, and missed opportunities for innovation and competitive advantage. It demonstrates a short-sighted perspective that prioritizes immediate cost avoidance over long-term value creation and risk management. Another incorrect approach that involves lobbying to weaken environmental regulations is ethically dubious and professionally risky. While lobbying is a legitimate activity, using it to undermine environmental protection can lead to severe reputational damage, alienate stakeholders, and potentially result in legal challenges if it is perceived as an attempt to circumvent public interest. It signals a disregard for societal well-being and sustainable development. A third incorrect approach that involves selectively disclosing environmental performance data to highlight positive aspects while omitting negative ones is a clear ethical and potentially regulatory failure. This constitutes misleading communication and a breach of transparency, which are fundamental tenets of responsible corporate behavior and are often mandated by disclosure regulations. Such practices erode trust with investors, regulators, and the public. The professional decision-making process for similar situations should involve a comprehensive stakeholder analysis, identifying all parties affected by environmental decisions and understanding their expectations. It requires a thorough understanding of current and emerging environmental regulations and industry best practices. Professionals should adopt a proactive risk management framework that anticipates potential environmental liabilities and opportunities. Furthermore, integrating sustainability into the company's strategic planning and operational processes, fostering a culture of environmental responsibility, and ensuring transparent and accurate reporting are crucial for long-term success and ethical conduct. Question 12. Compliance review shows that a significant existing investor is strongly advocating for an increased dividend payout from retained earnings, citing their immediate need for returns. However, the company's strategic plan requires substantial reinvestment in research and development and market expansion over the next 3 years to maintain its competitive edge and achieve long-term growth targets. How should the company's management and board approach this situation to ensure adherence to best practices and regulatory expectations? Option A. Propose a dividend that significantly depletes retained earnings, assuming the investor's immediate needs are paramount and future growth can be addressed through external financing. Option B. Reject the investor's request outright without further discussion or explanation to protect retained earnings for future investments. Option C. Prioritize the company's long-term strategic objectives and stakeholder interests by carefully evaluating the dividend proposal against its impact on future growth and financial stability, and engaging in transparent communication with the investor. Option D. Immediately approve the increased dividend payout as requested by the significant investor to maintain a positive relationship and avoid potential shareholder disputes. The correct answer is C. Prioritize the company's long-term strategic objectives and stakeholder interests by carefully evaluating the dividend proposal against its impact on future growth and financial stability, and engaging in transparent communication with the investor. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the immediate financial interests of a key stakeholder, the existing investor, with the long-term strategic goals and potential future value creation for the company and its other stakeholders. The pressure to prioritize short-term gains, especially from a significant investor, can lead to decisions that might not be in the best overall interest of the company's sustainable growth or its broader stakeholder base. Careful judgment is needed to assess the true impact of the proposed dividend on future investment capacity and market perception. Correct approach analysis. Prioritizing the company's long-term strategic objectives and the interests of all stakeholders, including future investors and employees, represents best professional practice. This approach aligns with principles of sustainable business development and corporate social responsibility. From a regulatory perspective, while not explicitly stated in the Vanke hiring assessment test syllabus, general principles of corporate governance and fiduciary duty often require directors and management to act in the best interests of the company as a whole, which encompasses long-term value creation and the well-being of all stakeholders, not just current shareholders seeking immediate returns. This proactive stance ensures the company remains attractive for future investment and can meet its obligations to all parties. Incorrect approach is analysis, focusing solely on the existing investor's demand for a higher dividend, without considering the impact on retained earnings and future growth prospects, would be a regulatory and ethical failure. This approach prioritizes a single stakeholder's short-term financial gain over the company's long-term viability and the interests of other stakeholders. It could be seen as a breach of fiduciary duty if it demonstrably harms the company's future capacity to operate, innovate, or meet its obligations. Ignoring the investor's request entirely without proper justification or communication would also be professionally unacceptable. This could lead to strained relationships with key investors, potentially impacting future funding and market confidence. While not a direct regulatory breach in itself, it demonstrates poor stakeholder management and a lack of engagement, which can indirectly lead to reputational damage and difficulties in future capital raising. Proposing a dividend that significantly depletes reserves, even if approved by the board, without a clear strategic rationale for why such a distribution is necessary or beneficial in the long run, would be a failure. This approach risks undermining the company's financial stability and its ability to fund essential operations or strategic initiatives, potentially leading to future financial distress and regulatory scrutiny. Professional reasoning. Professionals should adopt a stakeholder-centric decision-making framework. This involves identifying all relevant stakeholders, understanding their interests and potential impacts, and evaluating decisions against the company's long-term strategic goals and ethical principles. When faced with conflicting interests, such as between a current investor's demand for immediate returns and the company's need for retained earnings for growth, professionals should 1. Gather comprehensive information on the financial implications of the proposed action. 2. Assess the impact on all stakeholder groups. 3. Evaluate the decision against the company's strategic objectives and risk appetite. 4. Seek to find a balanced solution that maximizes overall stakeholder value and long-term sustainability. 5. Communicate transparently with stakeholders about the rationale behind decisions. Question 13. System analysis indicates that a Vanke client who has been investing for several years with a moderate risk tolerance and a long-term growth objective is now expressing an urgent need for a significant sum of money due to an unexpected personal emergency. The client is understandably anxious and suggests liquidating a substantial portion of their investment portfolio to access the funds immediately. As a Vanke financial advisor, what is the most appropriate course of action to take in this situation? Option A. Advise the client that their request is not aligned with their stated long-term investment goals and refuse to liquidate any assets, suggesting they seek alternative financing. Option B. Immediately proceed with liquidating the client's most liquid assets to provide the funds as quickly as possible, as the client's immediate need is paramount. Option C. Recommend a high-risk short-term trading strategy to generate the required funds within a few days, assuring the client of quick returns. Option D. Engage in a detailed discussion with the client to understand the precise nature and urgency of their financial need, explore alternative funding sources, and assess the impact of liquidating specific assets versus others, considering tax implications and potential long-term growth disruption. The correct answer is D. Engage in a detailed discussion with the client to understand the precise nature and urgency of their financial need, explore alternative funding sources, and assess the impact of liquidating specific assets versus others, considering tax implications and potential long-term growth disruption. Explanation. Scenario analysis. This scenario presents a professional challenge where a financial advisor, acting on behalf of Vanke, must balance the immediate financial needs of a client with the long-term implications of investment decisions. The client's urgent need for funds, coupled with their limited understanding of market volatility, creates a conflict between client satisfaction and prudent financial advice. The advisor must navigate this by considering the client's risk tolerance, investment objectives, and the prevailing market conditions, all within the regulatory framework governing financial advice. Correct approach analysis. The correct approach prioritizes a thorough understanding of the client's financial situation and objectives before recommending any course of action. This involves a detailed discussion about the client's risk tolerance, time horizon, and liquidity needs. The advisor should then explain the potential consequences of selling investments prematurely, including capital gains tax implications and the loss of potential future growth. The recommendation should be tailored to the client's specific circumstances, offering solutions that minimize adverse impacts while addressing the immediate need for funds. This aligns with the Vanke hiring assessment test's emphasis on client-centric advice and adherence to ethical standards, ensuring that recommendations are suitable and in the client's best interest, as mandated by general principles of financial advisory conduct. Incorrect approaches analysis. One incorrect approach involves immediately liquidating the client's entire portfolio to meet their stated need. This fails to consider the potential long-term damage to the client's wealth, the tax implications of such a sale, and whether this is truly the most suitable solution given the client's overall financial plan. It prioritizes immediate client demand over responsible financial stewardship and could be seen as a failure to exercise due diligence. Another incorrect approach is to dismiss the client's request outright without exploring alternatives or understanding the underlying reasons for their urgent need. This demonstrates a lack of empathy and a failure to engage in a consultative process. It neglects the advisor's duty to understand and address client needs, potentially leading to client dissatisfaction and a breach of professional conduct. A third incorrect approach is to recommend a high-risk, short-term investment strategy to generate the required funds quickly. This disregards the client's risk tolerance and the inherent volatility of such strategies, potentially exposing the client to significant losses. It prioritizes speed over suitability and could lead to a breach of the advisor's duty of care. Professional reasoning. Professionals should adopt a structured decision-making process that begins with active listening and information gathering. This involves understanding the client's stated needs, underlying motivations, and broader financial context. Subsequently, professionals must assess the available options, considering their implications in terms of risk, return, liquidity, and tax efficiency. The final step involves presenting a clear, reasoned recommendation that is tailored to the client's best interests and aligns with regulatory and ethical obligations. This process ensures that advice is not only compliant, but also demonstrates professional integrity and a commitment to client well-being. Question 14. Process analysis reveals that Vanke is facing a critical decision regarding a potential strategic partnership that promises significant short-term financial returns. However, preliminary information suggests the potential partner has a history of aggressive business practices and has faced minor regulatory inquiries in their primary market. The executive responsible for this decision is under pressure to secure the deal quickly to meet quarterly financial targets. Which of the following approaches best reflects a responsible and compliant decision-making framework in this context? Option A. Rely on informal assurances from the potential partner that their past issues are resolved and that Vanke will not face any repercussions. Option B. Engage legal counsel and conduct thorough due diligence on the potential partner's business practices and regulatory history, and present findings to the board for approval before proceeding. Option C. Proceed with the partnership immediately to capitalize on the financial opportunity, assuming the regulatory inquiries are minor and will not impact Vanke. Option D. Halt discussions with the potential partner and seek alternative opportunities that present fewer ethical and regulatory concerns. The correct answer is C. Proceed with the partnership immediately to capitalize on the financial opportunity, assuming the regulatory inquiries are minor and will not impact Vanke. Explanation. This scenario presents a professional challenge due to the inherent conflict between immediate financial pressures and long-term strategic integrity. The decision-maker must balance the urgent need for capital with the potential reputational damage and regulatory scrutiny that could arise from a hasty or ethically compromised transaction. Careful judgment is required to ensure that any decision aligns with Vanke's stated values and the regulatory expectations of the Vanke hiring assessment test jurisdiction, which emphasizes transparency, fairness, and responsible corporate conduct. The correct approach represents best professional practice because it prioritizes a thorough, multifaceted evaluation before committing to a significant decision. This involves not only assessing the financial viability of the proposed partnership, but also rigorously examining its ethical implications and compliance with all relevant regulations. By engaging legal counsel and conducting due diligence, the decision-maker demonstrates a commitment to responsible governance and risk mitigation, which are paramount in maintaining stakeholder trust and regulatory compliance. This systematic process ensures that decisions are informed, defensible, and aligned with the long-term interests of the company and its stakeholders, adhering to the principles of sound corporate decision-making expected within the Vanke hiring assessment test framework. An incorrect approach that focuses solely on the immediate financial gain without considering the broader implications would be professionally unacceptable. This would represent a failure to uphold ethical standards by potentially overlooking red flags related to the partner's business practices or regulatory standing. Such an oversight could lead to significant reputational damage, financial penalties, and legal repercussions, violating the spirit of responsible business conduct. Another incorrect approach that involves bypassing established internal review processes, such as seeking approval from the board or relevant committees, would be a direct contravention of corporate governance principles and likely regulatory guidelines. This demonstrates a disregard for accountability and oversight, increasing the risk of making a decision that is not in the best interest of the company or its shareholders. It also signals a lack of respect for established procedures designed to protect the organization from undue risk. A third incorrect approach that involves making a decision based on personal relationships or informal assurances, rather than objective data and due diligence, is also professionally unsound. This introduces bias and subjectivity into the decision-making process, undermining the principles of fairness and objectivity. It exposes the company to significant risks, as informal assurances are not legally binding and may not reflect the true nature of the proposed partnership or the partner's capabilities and integrity. The professional decision-making process for similar situations should involve a structured framework that includes clearly defining the problem and objectives, gathering relevant information from all necessary sources, financial, legal, operational, ethical, identifying and evaluating potential courses of action, assessing the risks and benefits of each option, including regulatory and ethical considerations, consulting with relevant stakeholders and experts, making a well-reasoned decision based on the comprehensive analysis, and implementing and monitoring the decision. This systematic approach ensures that decisions are robust, ethical, and aligned with regulatory requirements and organizational values. Question 15. Operational review demonstrates that a junior analyst, responsible for recommending investment strategies for a key client portfolio, has recently acquired a significant personal stake in a company that is a prominent target for the client's upcoming investment. The analyst believes their personal holding is unlikely to sway their professional judgment, but they are aware of the potential for perceived bias. What is the most appropriate course of action for the analyst in this situation? Option A. Proceed with the investment recommendation, confident that their personal holding is too small to influence their objective analysis. Option B. Discuss the situation with a trusted senior colleague to get their opinion on whether disclosure is truly necessary. Option C. Discreetly sell their personal holding before making the recommendation to avoid any appearance of impropriety. Option D. Immediately disclose the personal investment to the compliance department and await further guidance on managing the conflict of interest. The correct answer is D. Immediately disclose the personal investment to the compliance department and await further guidance on managing the conflict of interest. Explanation. Scenario analysis. This scenario presents a professional challenge where a team member's personal financial interests could potentially conflict with the company's best interests and regulatory obligations. The core difficulty lies in identifying and managing this conflict of interest transparently and ethically, ensuring that client decisions are not influenced by personal gain. The Vanke hiring assessment test, in its focus on decision-making frameworks, emphasizes the importance of integrity and adherence to establish protocols when such situations arise. Careful judgment is required to balance individual autonomy with the fiduciary duties owed to clients and the company. Correct approach analysis. The correct approach involves immediate and full disclosure of the potential conflict of interest to the relevant compliance department or supervisor. This aligns with best professional practice as mandated by regulatory frameworks like those governing financial services, which prioritize transparency and the prevention of insider dealing or market manipulation. By reporting the situation, the individual initiates a formal process where the company can assess the risk and implement appropriate controls, such as recusal from specific decisions or transactions. This upholds the principle of acting in the best interest of the client and the firm, ensuring that all decisions are made on objective merit and not influenced by personal financial incentives. This proactive disclosure is a cornerstone of ethical conduct and regulatory compliance, preventing potential harm to clients and the firm's reputation. Incorrect approaches analysis. Proceeding with the investment decision without disclosing the personal holding is a significant regulatory and ethical failure. It constitutes a breach of trust and potentially violates regulations against insider trading or market abuse, depending on the specifics of the investment and the information available. This approach prioritizes personal gain over professional duty and client welfare, creating an unacceptable risk of market manipulation or unfair advantage. Attempting to justify the decision by claiming the personal holding is small and unlikely to influence judgment is also professionally unacceptable. Regulatory frameworks do not typically allow for subjective assessments of influence based on the size of a personal holding. The mere existence of a potential conflict necessitates disclosure and management. This approach demonstrates a disregard for established compliance procedures and a failure to understand the strict requirements for managing conflicts of interest. Seeking advice from a colleague, outside of the formal compliance channels, while seemingly an attempt to gain perspective, is insufficient and potentially problematic. While collegial advice can be valuable, it does not substitute for the formal reporting and assessment required by compliance departments. This approach risks circumventing established protocols and may not lead to the appropriate regulatory or ethical resolution of the conflict. It can also inadvertently involve another party in a non-compliant situation. Professional reasoning. Professionals facing potential conflicts of interest should employ a structured decision-making framework. This typically involves 1. Identification, recognizing the potential for a conflict. 2. Disclosure, immediately reporting the conflict to the appropriate authority, e.g., compliance supervisor. 3. Assessment, allowing the designated authority to evaluate the risk and determine necessary actions. 4. Action, adhering strictly to the prescribed actions, which may include recusal, divestment, or enhanced monitoring. 5. Documentation, ensuring all steps are properly documented. This systematic approach ensures that conflicts are managed transparently, ethically, and in compliance with all applicable regulations, safeguarding both client interests and the integrity of the financial markets. Question 16. Benchmark analysis indicates that junior analysts often face situations requiring judgment regarding potential financial reporting irregularities. Ms. Chen, a junior analyst at Vanke, has reviewed a client's quarterly report and noticed a significant and unusual fluctuation in a specific expense category that is not adequately explained by the accompanying notes. She suspects this might be a misstatement, but she is not entirely certain. What is the most appropriate immediate course of action for Ms. Chen? Option A, discuss her suspicions with other junior analysts in her department to gather their opinions. Option B, ignore the fluctuation, assuming it is a minor clerical error that will be corrected later. Option C, immediately contact the client to request a detailed explanation for the fluctuation. Option D, document her findings meticulously and escalate the matter to her direct supervisor for review and guidance. The correct answer is C. Immediately contact the client to request a detailed explanation for the fluctuation. Explanation. Scenario analysis. This scenario presents a professional challenge where a junior analyst, Ms. Chen, has identified a potential discrepancy in a client's financial reporting that could indicate misstatement or fraud. The challenge lies in balancing the need for thorough investigation and adherence to internal procedures with the potential urgency of the situation and the impact on client relationships. Ms. Chen must exercise sound judgment in deciding how to escalate and address this issue without prematurely making accusations or causing undue alarm. Correct approach analysis. The correct approach involves Ms. Chen meticulously documenting her findings and then escalating the matter to her direct supervisor, Mr. Li, who is a senior member of the team with more experience and authority. This aligns with standard professional practice and regulatory expectations for handling potential compliance or financial reporting issues. It ensures that the issue is reviewed by someone with the appropriate expertise and that the firm's established protocols for investigation and client communication are followed. This systematic escalation prevents premature conclusions and allows for a coordinated and informed response, safeguarding both the firm's reputation and the client's interest while adhering to principles of due diligence and professional skepticism. Incorrect approach is analysis. One incorrect approach is for Ms. Chen to immediately confront the client directly with her suspicions. This is professionally unacceptable because it bypasses established internal review processes, could lead to an inaccurate accusation if her initial assessment is flawed, and could severely damage the client relationship. It also violates the principle of professional skepticism by acting on an unverified suspicion without proper consultation. Another incorrect approach is for Ms. Chen to ignore the discrepancy, assuming it is a minor error or not her responsibility to pursue further. This is a significant ethical and professional failure. It demonstrates a lack of professional skepticism and a disregard for the firm's duty to ensure the accuracy of financial information. Such an action could lead to material misstatements going undetected, potentially harming investors and other stakeholders, and exposing the firm to regulatory sanctions and reputational damage. A third incorrect approach is for Ms. Chen to discuss her suspicions with colleagues outside of the direct reporting line, or without the explicit instruction of her supervisor. This could lead to the unauthorized disclosure of sensitive client information, breach confidentiality agreements, and create unnecessary speculation or panic within the firm. It undermines the structured process for handling sensitive findings and could compromise the integrity of any subsequent investigation. Professional reasoning. Professionals should employ a structured decision-making framework when encountering potential issues. This framework typically involves 1. Observation and documentation. Clearly identify and record the observed issue with supporting evidence. 2. Preliminary assessment. Conduct a brief, objective assessment of the potential significance of the issue. 3. Consultation and escalation. Consult with a supervisor or designated authority according to established procedures. 4. Investigation and verification. Follow the guidance of the supervisor to conduct a thorough and objective investigation. 5. Action and resolution. Implement appropriate actions based on verified findings and in consultation with relevant parties. This systematic approach ensures that issues are handled professionally, ethically, and in compliance with all applicable regulations and firm policies. Question 17. Quality control measures reveal a significant variance between the reported project completion percentage by a key development team and the actual physical progress observed during a site inspection. The team attributes this to a temporary data lag in their internal tracking system. What is the most appropriate immediate course of action? Option A. Accept the development team's explanation and proceed with the originally planned reporting schedule to avoid causing alarm. Option B. Initiate an independent verification of the project's actual progress and the reasons for the discrepancy before any external reporting is finalized. Option C. Immediately escalate the issue to senior management, highlighting the potential for significant project delays and financial implications. Option D. Instruct the development team to immediately adjust their internal tracking system to align with the reported figures. The correct answer is B. Initiate an independent verification of the project's actual progress and the reasons for the discrepancy before any external reporting is finalized. Explanation. Scenario analysis. This scenario presents a professional challenge where a discrepancy in reported project progress could have significant implications for investor confidence and regulatory compliance. The pressure to meet deadlines and maintain a positive image can lead to biased decision-making. It is crucial to approach this situation with objectivity and a commitment to accurate reporting, even if it means acknowledging delays. Correct approach analysis. The correct approach involves a thorough, independent investigation to ascertain the true status of the project. This aligns with the principles of professional integrity and due diligence expected of individuals in the financial sector. Specifically, it upholds the Vanke hiring assessment test's emphasis on ethical conduct and accurate representation of financial information. By seeking objective verification, the professional demonstrates a commitment to transparency and responsible stakeholder communication, which are fundamental to maintaining trust and adhering to any implied regulatory expectations of honest reporting. Incorrect approach is analysis. One incorrect approach involves immediately accepting the team's explanation without further scrutiny. This fails to exercise professional skepticism and could lead to the dissemination of inaccurate information, potentially violating principles of honest reporting and misleading stakeholders. It bypasses the critical step of verification, which is essential for sound decision-making. Another incorrect approach is to dismiss the discrepancy outright and proceed with the original reporting schedule. This demonstrates a lack of diligence and a disregard for potential underlying issues. It prioritizes expediency over accuracy, which is ethically unsound and could have serious consequences if the reported progress is indeed inflated. A third incorrect approach is to confront the team aggressively and demand an immediate resolution without understanding the root cause. While addressing the issue is important, an accusatory tone can hinder open communication and prevent a genuine understanding of the situation. This approach lacks the professional maturity required for effective problem solving and could damage team morale and future collaboration. Professional reasoning. Professionals facing such discrepancies should employ a structured decision-making framework. This involves 1. Acknowledging the discrepancy and its potential impact. 2. Initiating an objective investigation to gather facts. 3. Consulting relevant internal policies and any applicable external guidelines. 4. Communicating findings transparently to appropriate parties. 5. Developing and implementing corrective actions based on verified information. This systematic approach ensures that decisions are data-driven, ethically sound, and aligned with professional responsibilities. Question 18. Strategic planning requires a clear understanding of how to allocate resources effectively to achieve both immediate objectives and long-term growth. Imagine Vanke is considering a significant investment in a new market segment. Which of the following approaches best reflects a robust decision-making framework for this strategic initiative? Option A. Prioritize cost-cutting measures across existing operations to free up capital, and then make a reactive investment in the new market segment if competitors show early success. Option B. Rely on historical sales data from unrelated markets and personal intuition to determine the optimal investment level for the new market segment. Option C. Conduct a comprehensive market analysis, including competitor assessment, potential demand, regulatory landscape, and financial projections, to evaluate the viability and potential return on investment of the new market segment before committing resources. Option D. Immediately allocate a substantial portion of the budget to the new market segment based on the enthusiasm of a few key sales team members who believe it is a promising opportunity. The correct answer is C. Conduct a comprehensive market analysis, including competitor assessment, potential demand, regulatory landscape, and financial projections, to evaluate the viability and potential return on investment of the new market segment before committing resources. Explanation. This scenario presents a professional challenge because it requires balancing immediate financial pressures with long-term strategic goals and regulatory compliance. The pressure to meet short-term targets can lead to decisions that compromise future growth or violate ethical standards. Careful judgment is needed to navigate these competing demands. The correct approach represents best professional practice because it prioritizes a thorough, data-driven assessment of all strategic options, considering their long-term implications and alignment with Vanke's overarching mission and values. This aligns with principles of responsible corporate governance and sustainable business development, which are implicitly expected in professional assessments like the Vanke Hiring Assessment Test. It demonstrates an understanding that strategic decisions are not solely about immediate profit, but also about building enduring value and maintaining stakeholder trust. An incorrect approach that focuses solely on immediate cost-cutting without considering the impact on innovation or market position would be professionally unacceptable. This could lead to regulatory scrutiny if it involves actions that are misleading to investors or customers, or if it violates any implied duty of care to employees or the market. Another incorrect approach that prioritizes a single, unverified strategic initiative without due diligence risks misallocation of resources and potential failure, which is contrary to prudent financial management and strategic planning principles. A third incorrect approach that relies on anecdotal evidence or personal bias rather than objective analysis undermines the integrity of the decision-making process and can lead to suboptimal outcomes, failing to meet the standards of professional rigor expected in a hiring assessment. Professionals should use a structured decision-making framework that involves defining the strategic objective, gathering relevant data and insights, identifying and evaluating potential strategic options, assessing risks and rewards for each option, selecting the most appropriate strategy based on comprehensive analysis, and establishing mechanisms for monitoring and adapting the strategy over time. This systematic approach ensures that decisions are well-informed, defensible, and aligned with both short-term needs and long-term vision. Question 19. System analysis indicates that a long-term client who has consistently followed your advice expresses a strong preference for a particular investment strategy that, upon initial review, appears to carry a higher risk profile than typically recommended for their stated financial goals and risk tolerance, and may also present complexities regarding reporting under current Vanke assessment guidelines. How should a professional approach this situation to ensure both client satisfaction and adherence to professional standards? Option A. Inform the client that their preferred strategy is not viable due to regulatory concerns and suggest they seek advice elsewhere. Option B. Conduct a thorough risk assessment of the client's preferred strategy, compare it against regulatory guidelines for reporting, and present the client with a clear, evidence-based analysis of the pros and cons, including alternative strategies that better align with their goals and regulatory compliance. Option C. Immediately implement the client's preferred strategy, assuming their experience and stated preference outweigh any potential concerns, to maintain client goodwill. Option D. Proceed with the client's preferred strategy, but make minor adjustments to the reporting to simplify it, without explicitly discussing these adjustments or their regulatory implications with the client. The correct answer is B. Conduct a thorough risk assessment of the client's preferred strategy, compare it against regulatory guidelines for reporting, and present the client with a clear, evidence-based analysis of the pros and cons, including alternative strategies that better align with their goals and regulatory compliance. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the potential for that preference to lead to suboptimal outcomes or even regulatory noncompliance. The professional must navigate the client's autonomy while upholding their fiduciary duty and adhering to regulatory standards. The pressure to satisfy a client, especially a long-standing one, can create a bias towards simply acceding to their wishes, which is a common pitfall in decision-making. Correct approach analysis. The correct approach involves a thorough, objective assessment of the client's request against all relevant regulatory requirements and best professional practices. This means not just accepting the client's stated preference at face value, but critically evaluating its implications. It requires the professional to act as a trusted advisor, providing clear, evidence-based recommendations that prioritize the client's long-term interests and regulatory adherence. This aligns with the Vanke hiring assessment test's emphasis on a structured decision-making framework that prioritizes diligence, compliance, and client welfare over expediency or simple acquiescence. The professional's duty is to guide the client towards the most appropriate course of action, even if it differs from their initial inclination, by clearly articulating the rationale and potential consequences. Incorrect approaches analysis. One incorrect approach involves immediately agreeing to the client's request without further investigation. This fails to uphold the professional's duty of care and diligence. It bypasses the critical step of assessing the request against regulatory frameworks and best practices, potentially leading to non-compliance or detrimental outcomes for the client. This demonstrates a lack of professional skepticism and an abdication of responsibility. Another incorrect approach is to dismiss the client's request outright without understanding the underlying reasons or exploring potential alternatives. While the request might be problematic, a complete dismissal without engagement can damage the client relationship and may overlook valid concerns the client has that could be addressed through a modified approach. This lacks the nuanced problem-solving expected of a professional. A third incorrect approach is to proceed with the client's request, but attempt to subtly mitigate risks without full disclosure to the client or regulatory bodies. This is ethically unsound and potentially fraudulent. It involves a lack of transparency and a deliberate attempt to circumvent established procedures or regulations, which is a severe breach of professional conduct and trust. Professional reasoning. Professionals should employ a structured decision-making framework that begins with understanding the client's objective, followed by a comprehensive assessment of all relevant factors, including regulatory requirements, potential risks, and alternative solutions. This framework should include seeking clarification, conducting due diligence, evaluating options based on objective criteria, and then presenting a clear, reasoned recommendation to the client, explaining the rationale and potential consequences of each path. Transparency and adherence to ethical and regulatory standards must be paramount throughout the process. Question 20. Governance review demonstrates that a specific business unit has consistently exceeded its quarterly revenue targets by utilizing a sales practice that, while not explicitly prohibited, operates in a gray area of the company's internal guidelines and could be perceived as aggressive by regulators. The unit head is advocating for continued use of this practice, citing its proven effectiveness in meeting performance metrics. What is the most appropriate course of action for a compliance officer who identifies this situation? Option A. Immediately escalate the matter to the compliance department and senior management for a formal review of the sales practice and its potential regulatory implications, recommending a temporary suspension of the practice pending the review. Option B. Focus on the positive revenue outcomes achieved by the business unit and recommend that the current sales practice be maintained as it is clearly effective. Option C. Advise the business unit head to subtly modify the practice to appear less aggressive, without formally documenting the change or seeking external guidance. Option D. Continue to monitor the sales practice without immediate intervention, assuming that if it were truly problematic, regulators would have already flagged it. The correct answer is A. Immediately escalate the matter to the compliance department and senior management for a formal review of the sales practice and its potential regulatory implications, recommending a temporary suspension of the practice pending the review. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between achieving short-term performance targets and upholding long-term ethical and regulatory standards. The pressure to meet immediate financial goals can tempt individuals to overlook or rationalize potentially problematic practices. Navigating this requires a robust decision-making framework that prioritizes integrity and compliance over expediency. The challenge lies in identifying subtle deviations from best practice and understanding the downstream consequences of compromising ethical principles. Correct approach analysis. The correct approach involves a systematic review of the governance framework and its practical application. This entails not just identifying the deviation, but also understanding its root cause within the existing policies and procedures. The emphasis on seeking clarification from the compliance department and senior management demonstrates adherence to established reporting lines and a commitment to resolving issues through proper channels. This proactive engagement ensures that any decision made is informed by expert guidance and aligns with the company's risk appetite and regulatory obligations. It reflects best professional practice by prioritizing transparency, accountability, and a thorough understanding of the regulatory landscape before taking any action. This approach safeguards the company from potential legal repercussions, reputational damage, and ethical breaches. Incorrect approach is analysis. One incorrect approach focuses solely on the immediate financial benefit without considering the underlying governance issues. This represents a failure to adhere to the principle of conduct risk, which mandates that firms manage their businesses in a way that ensures they achieve their business objectives without compromising regulatory standards. It also ignores the potential for such short-sighted decisions to create systemic risks. Another incorrect approach involves attempting to fix the issue internally without involving the appropriate oversight bodies. This bypasses crucial checks and balances designed to ensure compliance and ethical conduct. It can lead to a situation where the problem is only superficially addressed, or worse, concealed, creating a greater risk of future violations and a breakdown of trust within the organization. This demonstrates a lack of accountability and a disregard for the established governance structure. A third incorrect approach, which involves proceeding with the action while acknowledging the potential governance gap, but assuming it will be rectified later, is also professionally unacceptable. This is a form of willful blindness and a failure to act with due diligence. It places personal convenience or the achievement of immediate goals above the company's legal and ethical responsibilities. This approach demonstrates a disregard for the principle of treating customers fairly if the governance gap impacts client outcomes, and a failure to uphold the integrity of financial markets. Professional reasoning. Professionals facing such situations should employ a structured decision-making framework. This typically involves 1. Identifying the issue and its potential implications: ethical, regulatory, financial, reputational. 2. Gathering relevant information including policies, procedures, and expert advice, e.g., from compliance or legal departments. 3. Evaluating the available options against established principles, regulation, and the company's risk appetite. 4. Selecting the option that best upholds ethical standards and regulatory compliance, even if it means sacrificing short-term gains. 5. Documenting the decision-making process and the rationale behind the chosen course of action. This systematic approach ensures that decisions are well considered, defensible, and aligned with professional responsibilities.